Brad Williams, Frugal Finance. Consumption commodities. What's this all about? When we talk about consumption commodities, we mean things that people or companies use directly, like oil or wheat, rather than things that they buy to make money later, like stocks or bonds. These consumption commodities don't usually give you any extra money, but it can cost you to store them safely. Let's say we're looking at the price of these things now compared to what they might cost in the future. If the price in the future is higher than what it would be if you bought it now and added the cost of storing it, there's a way to make some easy profit. You'd borrow some money at a safe interest rate, buy the commodity, and pay the storage cost. Then you'd promise to sell it for the higher price in the future. But here's the thing. When lots of people start doing this trick, the price of the commodity goes up now and the future price goes down until it's not worth doing anymore. The same goes for when the future price is lower than what you'd expect. People will start buying it now, storing it themselves, and promising to sell it in the future for that higher price. This drives up the current price and brings down the future price until it's not worth it anymore. So in the end, the future price usually ends up being just right, considering what it would cost to buy it now, store it later, plus a little extra makeup for not having the money now. But this doesn't always work for things people plan to use right away, like oil. They're not keen on selling it now just to promise to buy it later, because you can't really use a promise to buy oil to run a refinery, for example. So for these kinds of things, the future price might not be higher than the current price plus storage costs and interest. It might be the same or even a bit lower. When it comes to commodities that serve as a consumption asset rather than investment assets, they generally do not generate income, but may incur substantial storage expenses. Let's delve into a few arbitrage tactics used to establish future prices based on spot prices. Imagine we depart from the conventional formula F of O is equal to S of O plus U times EXPR of T, and instead we consider F of O is greater than S of O plus U times EXPR times T. Here, an arbitrager can do the following. Borrow an amount S of O plus U at the risk-free rate and use it to purchase 1 unit of the commodity and pay storage costs. Also short 1/4 contract on the commodity. If we regard the futures contract as a forward contract, this strategy leads to a profit of F of O minus S of O plus U times EXPR of T at time of T. There's no problem implementing the strategy for any commodity. However, as arbitragers do so, there will be a tendency for S of O to increase and F of O to decrease until F of O greater than S of O plus, etc. is no longer true. We conclude F of O, S of O of U cannot hold for any significant length of time. Let's say next, F of O is less than S of O plus U times EXPR If the commodity is an investment asset, we can argue that many investors hold the commodity solely for investment. When they observe the inequality in F of O less than S of O plus U EXPR they will find it profitable to do the following. Sell the commodity, avoid storage costs, and invest the money at the risk-free interest rate by a long position forward contract. The outcome is a riskless profit at maturity of S of O plus U times EXPR of T. F of O minus F of O relative to the position the investor would have had if they held the commodity. It follows that F of O less than S of O U X of P cannot hold for long, because neither F of O greater than this nor F of O less than this can hold for long. We must have this, similar to what we have here. This approach can't be used for a consumption commodity. Individuals and companies who own a consumption commodity usually plan to use it in some way. They're reluctant to sell the commodity in the spot market and buy forward or future contracts because forward and future contracts cannot be consumed. For example, oil refiners cannot be used to feed a refinery. There is therefore nothing to stop F of O S plus U EXP from holding, and all we can assert for a consumption commodity is F of O less than this formula If storage costs are expressed as a proportion of U of the spot price, the equivalent result is F of O less than or equal to S of O times EXP, R plus whatever that is, T. Brad Williams, Frugal Finance. Thanks for watching.